We've got the CoinDesk third quarter review that's out, summarizing some of the key themes and metrics that highlight the quarter's progress in the crypto markets. And joining us now to discuss further is CoinDesk Research Analyst George Kaloudis. Hey there, George. Good morning. Congratulations on this new report. Really beefy findings. But what are some of the key takeaways from the report?
Yeah, good morning, guys. And first off, shout out to my co-author, Teddy, who is diligently working behind the scenes to make sure this thing gets published on our website on time while I talk about it. So it's always a really fun exercise to look back on a quarter when preparing these quarterly reports, because the first thing that comes to mind is, wow, did anything even happen? And then it's quickly followed with, wow, so much has happened. How are we going to really fit this into one broad takeaway? So you guys talked about price a little bit. Lawrence touched on volume. And I'd like to first say that from a price perspective, it felt as if Bitcoin and Ethereum were taking a collective breath following a quarter in Q2 where both hit all-time highs, but then came crashing down. You know, Bitcoin returned 25%, ending the quarter just below 44K, and Ethereum returned more than 30%. Ending the quarter around 3K, which both look hilariously low as we enter October, since that's proved to be, Uptober so far. This quarter has come with a lot less volatility, though, which wouldn't really necessarily be surprising if you're looking at the space on a weekly basis, because it did feel like we were just trading within this price band for basically an entire quarter. And Lawrence, I think you were alluding to this earlier. Another interesting trend we saw was that Bitcoin was returned to uncorrelatedness to the big macro assets for the entire quarter. Bitcoin spent the quarter uncorrelated to the S&P 500, bonds, gold, and the USD. And so that means like Bitcoin can claim its title back as a super unique asset. But as we show in our report, it's still tightly correlated to Ethereum, which shows that even if you are a digital asset investor with no Bitcoin exposure, and some reason you don't want to invest in Bitcoin and you want to invest in Ethereum and all these other Web3 projects, BTC is still something you need to pay attention to. It's still the big dog in the space. And another takeaway from the quarter comes again from the Bitcoin world. Following a Q2 crackdown from China, Bitcoin's hash rate fell, and it fell hard. But it actually grew over 40% during Q3, suggesting that miners either relocated or turned back on after a lack of enforcement by the Chinese government. And recently, the new crackdowns really cast doubt on that latter point, suggesting that Bitcoin successfully relocated a significant portion of its security infrastructure while experiencing no downtime, which is just absolutely crazy. So all this talk about the good stuff that happened in Bitcoin, there was an interesting stat that we focused on our report, and that was on Bitcoin, and I want to put quotes around this, losing dominance. So there's a measure known as the Bitcoin dominance measure, which is just the Bitcoin market capitalization as a percentage of the entire crypto market's market capitalization. And Bitcoin has lost dominance the past 3 years. But Bitcoin losing dominance doesn't imply that it isn't losing, right? Especially as it continues to cement itself as a sound money and global monetary network. This aligns with what we're referring to as the scalability summer, since a lot of discussion was to be had this summer around Bitcoin and Ethereum and how we can scale it. In El Salvador, Bitcoin was adopted as legal tender with the Lightning Network as its scaling solution, and the NFT craze made transactions and gas fees on Ethereum high enough to spark a glut of alternative layer ones. But despite all of this, these two assets are still king. And in the world of Bitcoin, waning dominance for Bitcoin more accurately suggests that there is money flowing into other projects with different use cases, which is what we typically see during times of optimism in digital assets. And that's not necessarily a problem. In fact, it's probably pretty exciting for the people at CoinDesk.
George, thank you so much. This is a fascinating report. I just want to turn to this question of correlations, because you're saying that Bitcoin and the stock market are becoming less correlated, but there are clearly some exceptions to that. We saw that with fears over Evergrande in China when the stock market went down quite dramatically in one day, and Bitcoin seemed pretty correlated with that. There was a price drop in the crypto markets that many were saying were linked to the larger crash in the market. Now we have concerns about debt default, which could obviously negatively impact the stock market. I mean, what are some exceptions where we see Bitcoin correlating more with the S&P 500?
Yeah, great question. And it's something that we actually have to wrestle with every day when we look at these assets. we like to think, especially as sort of early adopters of Bitcoin, that Bitcoin is this huge asset that's going to completely decoupled from everything that we already know now. And it's almost $1 trillion asset. So you would maybe expect for it to have a life of its own. But whether we like it or not, if two of the largest economies are looking down the barrel of potential financial turmoil, there's just no way that it's not going to touch every single asset. Now, in a world where Bitcoin may be a $10 trillion asset, $100 trillion asset, maybe this will be our saving grace and the true flight to quality that we have when, the U.S. government's going to fail or the Chinese economy is just going to fall apart. But I'd say for now, Bitcoin is still an aspirational store of value looking to be uncorrelated in the longer term to the other macro assets. This is still just one quarter where we saw the uncorrelatedness happen. If you see on the chart that's probably showing up right here, earlier in 2020, or actually Q3 2020 last year, we had more strong correlations, maybe not as strong as Ethereum, but it was affected by the other things in the market.
George, it seems to be on the uptrend, though. In other words, the correlation between Bitcoin and the S&P 500 seems to be returning back above that band, that uncorrelated band, to becoming, would you say, a risk-on asset at that point? Do you think Q4 will see us getting to higher correlations between the stocks and crypto?
Yeah, it's an interesting question. I'd say that Bitcoin is risk everything at this point. I don't really know if it has an identity because you have, I'd say, a really loud amount of people saying that it's risk off, and you have a loud amount of people saying it's risk on. In a world where bond yields are so low, I guess you could say it's a risk on asset if it's going to become more correlated with S&P. I don't think that will continue going forward. I think it'll try to continue its uncorrelatedness going forward. It'd be really cool to see a brand new asset that's doing things we've never seen before.
Another key theme of your report, George, is that scalability was on everyone's minds. And so maybe talk a bit about that. And what is the most scalable protocol?
Again, another interesting question. It has a lot of deep layers to it. When we talk about scalability, especially in these blockchain projects, you have to give up something in order to have fast and cheap transactions. In the world of Ethereum, Solana came from the depths to sort of take Ethereum's pedestal as sort of this really fast, scalable blockchain, but they did that at the expense of decentralization. And in fact, Solana said they could do 40,000 transactions per second, but they went down for 20 hours. So there were many transactions happening during that time period. It also sparks an interesting conversation of how do we scale these things? Are we going to keep building alternative layer one blockchains that can build bridges between the blockchains, or are we going to have blockchains with significant layers on top of it? So Bitcoin seems to be taking the path of layering their blockchains, while the smart contract world is looking sort of like it's going to be a multi-chain world.
George,
the answer is I'm not sure.
George, in the report, you were looking at volumes. You said they're increasing. You also said liquidity is falling. So can you explain what you mean by that and how exactly that works, and how are you defining liquidity?
Yeah. So Lawrence, you actually touched on this, and you said that so in Q2, Ethereum volumes actually exceeded Bitcoin volumes and on exchanges, and that actually almost happened again this quarter, which is pretty cool. Ethereum is really growing into being another investable asset for these big institutions. But when in our report, we say that liquidity for Bitcoin is falling, and that's a measure of on-chain liquidity, which is a measure of the amount of quote-unquote liquid supply compared to the amount of illiquid supply. And all that means is there are people who hold Bitcoin on-chain and they don't move it. So that's a large percentage of the Bitcoin that's out there, and that's the illiquid supply. The liquid supply that makes up 10% of total supply is the stuff that's held by exchanges or held by people with paper hands who are fine selling and putting it in and out of the asset. So while liquidity is falling on chain, there's still the highest level of brokerage level liquidity we've probably seen ever, right? You have new exchanges popping up every day. FTX is now the darling child of all these exchanges. And I think if all of us right now wanted to take our collective net worths and put it into Bitcoin, we'd have no trouble buying it. So there's definitely not a liquidity problem on a brokerage level. It's more of people who hold Bitcoin are less willing to part with it now.